All right, listen up. If you're an investor in Kenya, or even just watching the market from the sidelines, you're going to want to hear this. We're about to break down a massive shift that's coming, and it could change everything. And I'm not being dramatic here. The investment landscape that has defined the last few years, it's pretty much coming to an end. Because that's the year we're zeroing in on. That's the target for this whole transformation. And trust me, you want to be positioned for it now, not when everyone else is scrambling. Okay, let's get into it. So what is this big shift I'm talking about? Well, it all comes down to where the safe money has been hiding out. Think about it. For the past few years, it's been a pretty sweet deal, right? T-bill yields got as high as 18%. I mean, that's incredible. Almost risk-free return the government was offering to fight inflation and steady the shilling. But here's the thing about economic cycles. They always end. Now that stability is returning, those sky-high yields are expected to come back down to earth, and all that capital, it's going to need a new place to go. The logic here is actually super simple. It's just basic economics. Let's trace the cause and effect. Just look at this side-by-side comparison. It tells the whole story. As those T-bill yields drop, they suddenly look a lot less exciting, right? At the exact same time, lower interest rates mean it's cheaper for companies to borrow money, to invest in growth, and to boost their profits. So what happens? Capital naturally flows from the low-return safe zone right into stocks on the NSE that have huge growth potential. And here it is, broken down into two simple steps. First, the central bank declares victory. Inflation is under control and interest rates start to fall. Then comes step two. Investors from the big institutions to you and me start pulling their money out of T-bills and pouring it into the stock market to chase better returns. And that, right there, is what could spark a serious boom. So the million-shilling question is, how do you get ahead of this wave? Well, that brings us to a potential game plan, a playbook, if you will, with 7 companies that seem perfectly positioned to benefit from this exact shift. Let's start with the big one, the absolute anchor of any solid NSE portfolio. I mean, you can't even talk about Kenyan stocks without talking about the tech and finance giant that is Safaricom. Yeah, their main business in Kenya, it's an absolute cash cow. But the real story, the exciting part, is how M-Pesa is evolving into a full-blown fintech platform and how they're pushing the 5G rollout. This isn't just some short-term trade. A lot of people see this as one of the safest long-term bets on the entire exchange. All right, next up is a company that has totally rewritten the rules of banking in our region. Equity Group is so much more than a bank. It's like a financial inclusion engine that's firing on all cylinders across East Africa. Equity's entire strategy is about one thing: growth. They're all in on digital, they're laser-focused on small and medium businesses, and they're expanding like crazy across East Africa. This puts them in the perfect spot to capture the rise of the whole region's middle class, all while keeping their books clean and paying out solid dividends. Now for a classic recovery play. When the economy gets stronger and people have a little more cash in their pockets, what do? They spent it. And our third company, East African Breweries, or EABL, is sitting right in the path of that spending. As the top dog in the beverage game in Kenya, Uganda, and Tanzania, EABL is in a really powerful spot. They can basically set their own prices, and they've got a great track record of paying dividends. So as consumer confidence comes roaring back with a stronger economy, EABL is one to watch for a major surge. Our fourth pick is another banking behemoth, but it has a totally different vibe. We're talking about KCB Group, a bank known for being tough as nails and for having its eye on the really big projects that build a country. KCB's real strength is in lending to big corporations and for major infrastructure projects. Through some smart acquisitions, it's also perfectly placed to cash in on the whole Pan-African trade story. When Kenya's economy hits the gas, you can bet KCB's loan book is going to grow right along with it. And speaking of infrastructure, this next one is about as direct an investment as you can get in the physical growth of the nation. Think about it. All these huge government projects, like the Big Four agenda and its focus on affordable housing, what do they all need? Cement. Lots and lots of cement. Bamburi dominates that market. So as these massive projects really get going, heading towards 2026, the potential for explosive earnings is obvious. And with that, you'd expect some very healthy dividends too. Okay, let's switch gears to a more innovative player in the banking world. NCBA Group has done a brilliant job of carving out a special niche by going after a younger, more digitally savvy customer.
NCBA's secret sauce is its digital-first mindset. I mean, they were the pioneers behind M-Shwari, and they totally captured that younger, mobile-first generation. They've done a great job of adding new services, and on top of that, they're a high dividend payer with what looks like plenty of room for the stock price itself to climb.
And finally, let's talk about a defensive play. This is a company in what some might call a boring industry, but it's an industry that is absolutely essential.
Carbassets supplies industrial gases, the stuff that's critical for making food, drinks, and for healthcare. This isn't a flashy business, but that stable demand creates incredibly consistent cash flows. The result? It's one of the highest dividend-paying stocks on the entire NSE. It's a fantastic potential way to protect yourself if the market gets choppy.
So, there you have it, a 7-stock playbook, all built on a very clear thesis about where the market is headed. But if there's one thing to take away from all this, it's a sense of urgency.
This isn't some far-off theory that might happen decades from now. As those T-bill yields start to tick down, that money is going to start moving. And you really don't want to be the person buying these stocks after they've already taken off.
Look, all the signs are pointing to a major rotation of capital over the next couple of years. The shift is definitely coming. So the only real question left is your portfolio going to be ready to catch that wave?